sequestration has got a significant effect in the aerospace defense sector. Even though folks have known about it for about three years, it's now actually starting to take effect. So a lot of the tier one, Northrop Grumman's and the Boeings are looking at their supply chain. Essentially, it's like, okay, we need to grow revenue in a decreasing DoD spending environment. How do we do it? Well, naturally, it's through acquisitions, and I think the other sector that's seeing a very similar dynamic is healthcare, because of what's happening with Obamacare. There's so many different areas of healthcare that are affected by the legislation that I can't begin to tell you why one is hotter than the other, but there just seems to be a lot of churn, all focused on the outcome of that legislation, and specifically after the Supreme Court decision.
Yeah, the cost to small business obviously is going to be one issue that I think people will really understand completely yet. But then within the healthcare space, you have hospitals being affected, physicians groups. There's this new model called the Accountable Care Organization. People are still trying to figure out how that works, and does that have its own capital requirements, and that will lead to its own wave of consolidation. So there's a lot of activity in the healthcare space. I think Brueggemann Brothers has done a lot in the healthcare space, correct?
Yeah, I was going to say we've been probably 80–90% focused on healthcare the last 2.5 years.
Yeah.
We're starting to move away from it.
Really?
Yeah. So I think
what's driving that?
Because there's only going to be a handful of areas, at least in the near term, that people are looking to invest in. So yes, speaking to a sponsor 2 weeks ago that focuses exclusively on healthcare, and we've done a couple of deals with them. So it's getting very, very hard for us to find areas within healthcare that we're comfortable with.
What are some of the focuses of those?
Yeah, so I think anything that's taking cost out of the system, anything that has a long-term demographic positive outlook. So we do some work in outpatient physical therapy. Folks are looking for a lot of revenue cycle management companies, but it's just there's still enough uncertainty out there. I mean, you mentioned ACOs. That's been a hot button topic for 6 or 8 months.
But no one really knows how it's going to work.
Yeah, you get 10 different answers about how that's going to work and what they're going to look like. Even some of the statistics that you hear about the universe of folks that's going to be covered next year, you could read the CBO report, you could read other publications, you're going to get different data points. So I think until we start to see some of those headline items play out, it is creating uncertainty.
Right. Yeah, we were recently speaking with more of an entrepreneur, I guess. It was someone that had a sort of cost reduction information technology for use in the healthcare space. They had a very positive experience in a foreign country, foreign jurisdiction, a lot of success there. They want to roll it out in the U.S. But it's, again, how they're really going to get into that market and what it's going to look like, what the adoption rate is going to be, how they're going to penetrate, who their real audience is going to be.
Right.
Remains so unclear, it's hard to figure out. And on the ACO, it depends whether you're a hospital or whether you're a physician's group or a payer, who docs is going to get for. Because the physicians and the hospitals have completely divergent interests. The hospitals want to put heads in beds, and the doctors, that doesn't benefit the doctors as much as keeping the patient out of the hospital and in more of an outpatient setting.
Yeah, and I think even how people are going to get paid, how are you going to get compensated. So I think we're starting to see how it's going to come together, but there's still just enough uncertainty to make a lot of areas not financeable and not investable.
And are you hearing from any companies, any CEOs or CFOs, their concerns about the costs, you or either of the Patricks, around increasing healthcare costs?
That hasn't been an issue for a lot of folks.
I would say for small businesses, yes, they're concerned about the cost, they don't know what the cost is going to be. So that's one of the reasons.
So I can make one comment about healthcare M&A. I'm seeing, because we do a lot of that in our firm.
Right.
People that are willing to tolerate or buy risk have an
Yep.
opportunity to clean up.
Right.
Because there's a lot of risk, a lot of uncertainty, political uncertainty.
Mhm.
There's prosecutorial uncertainty.
Yeah.
You know, so there are deals to be had if you have a degree of fortitude.
Are you seeing that reflected in valuations?
I'm seeing it reflected in valuations and deal terms.
Right.
But a lot of sellers are nervous.
Uh-huh.
A lot of business owners are nervous. There are risks out there on the horizon that seem to be growing in some respects.
Right.
Increasingly uncertain in some respects.
And they may be at a point in their career or their ownership where they don't have a successor, or they're, I don't know if I can tolerate another 5 years of what I've just been through.
So, if you have air,
Yeah.
you get a deal.
Yeah, it's been weird. I mean, we talked about seller financing and how that's, what that looks like today. I mean, if we go back a year and a half, I look at a company that we sold at that point, it's basically the same as what we have in the market today. The valuations were pretty similar. We're 8 to 9 times, depending on how you look at EBITDA. But to get to that 8.5 times a year and a half ago, there was, a turn of seller paper and a turn in an earnout. Today, there's so much competition that it's all cash and rolling. So that's kind of changed over the last 18 months from what we've seen. But still, and this is a healthcare company, but you're still seeing, even though there's that much competition, we had 50 bids in this company, we had to rebid again in the process. There's still a little bit of reticence about what sequestration is going to cause,
Right.
other Medicare reductions. But I think the interest is still greater than some of the risks out there. But people are still there's exuberance, but it's not irrational. So it's
Rational exuberance. In terms of mechanics, have you guys seen any situations lately where you have a potential client or you have a business that maybe their banks are getting uncomfortable, or maybe there's a succession issue, and they want to get something done, but they're not ready. They don't have the information set up. They haven't really cleaned up the company and dressed it up for a process, and their expectations about how quickly they can get something done at a desirable valuation are completely unrealistic. This is something I feel like I see in the middle market and lower middle market a lot, and it's, if you're thinking you might need to be selling or doing something in the next year or 2 or 3, it's never too soon to start planning. You go ahead.
I mean, I'm sure I'll try the same response, and I'll talk quickly, but that's the case in 100% of the deals we do. Even the folks that are more well prepared have no idea what they're not prepared for.
Right.
So, the kind of data that the private equity guys want and the lenders want, they have no idea what that's going to entail, let alone getting into, the legal diligence, documentation. It's a process that, they've typically never been through before, and we spend a lot of our, so if it takes us, 6 months is on the low side.
Mm-hmm.
Even if it takes us 6 months to get a deal done, 3 months of that is going from LOI to closing, and just grinding it out with the company, getting data every month, dealing with all the diligence, data rooms, documentation. It's typically a completely foreign process to the company. So,
Yeah, go ahead, Patrick.
I laugh because 100% of the time is right. You're talking to a business owner and they sign, an engagement. They are expecting, like, selling a house. Like, I'm going to be in market next month, and
we're going to walk through and then we're going to close the next day.
and you're in a lose-lose situation, because on the one hand, what the buyers, especially the sophisticated ones, whether it's a strategic or private equity, what they expect
Right.
from a well-run sell-side process, from
Right.
a data room, fully functioning models, management presentations,
Mm-hmm. Business plan, prior year's business plans, how they performed against that, etc.
budget. But from a business owner, I'm gonna lose because I can't go to market until the company's ready, and the business owner wants to go to market, and every month that goes by,
You're losing time.
and so it's really, you know, you have to manage expectations. So the earlier that we can have a conversation with a potential client
Mhm.
and say, you know, if you're 3 years or 2 years out, there's literally checklists that have to be done, from succession to potential lawsuits to customer concentration, all these things that,
Yeah, if you need to divest anything, get rid of some old equipment, whatever you can do, you can really, it adds up in evaluation.
you need to start that 2 years in advance, because it takes that long. Does that happen? Rarely. But, you know, and
Because they don't want to take the time out of their, unless they see an endpoint with, you know, a big check and wire, like they're less like, they're not going to take time out of their running their business to do those things that we as bankers want to do.
The time and the money.
Yeah, it does cost.
So they have the skill set to do it too.
Yeah, you have to know who to call, and then do I trust that person? Do I interview 3 attorneys and 3 bankers and 3 accountants? And then you've got the incumbent attorney and accountant that probably don't have transactional experience that are saying, well, why do you want to do that? And if you want to do that, use us, and then hopefully they don't mess something up along the way. So, at least today, I can point to, you know, my clients and say, yes, it's painful now, but this is why you're doing this, and you're getting paid 9 times for your business, so you need to do this. And by the way, you're getting paid 9 times for your business, and it's not seller financed and earn out contingent, like some of your other peers were a year or 2 ago. So that, I think, softens the blow a little bit, but it's never an easy and painless process.
And on the special situation side, it's in some ways it's worse, because if you wait until your bank is on its 4th or 5th forbearance and they're getting sick of it, before you really start to plan how you're going to resolve the situation. Unfortunately, what we see too often, especially in the current environment where credit is so easy, and a lot of banks have just been pushing things out, pushing things down the road, hoping they solve themselves. By the time the bank finally decides to pull the plug, the business has been so capital constrained for so long that there's really nothing they can do. It often goes straight to a liquidation, when had they acted sooner, had the banks forced them to do something sooner, there could have been something to salvage and something to do with it.
Well, can I ask a question to you?
Sure.
Given that we've seen kind of valuations run up and interest rates are staying low, do you have any outlook or opinion on when kind of the credit cycle is going to change and you guys are going to get super busy on the restructuring?
You know, it's a good question. It's hanging on everyone's tongue.
Yeah.
It's funny because a year or 2 ago, it was very slow. And you could go to a reception or a conference or something, and people were like, yeah, we're busy, we've got some stuff kicking around, we just pitched a big better deal, and you kind of like, yeah, whatever. Now you go, and people are just kind of, dead, nothing. They don't even lie anymore. It's really, it's an interesting situation, because you look around and the economic fundamentals for a lot of people, a lot of businesses are not that strong. A lot of businesses have been able to reduce costs, and there is kind of a tepid recovery. Credit has been so easy, and the banks, once they got bailed out and the regulators were not breathing down their necks to clean up their balance sheets and get rid of troubled loans, could just sort of roll things forward. So you're not seeing a lot of credits hit the wall the way you would expect. No telling what's going to change that or when that's going to change. There's not a lot you don't think all rates are going to start to come up anytime soon. I don't know, Patrick, do you have any views on that?
I did restructuring too, and I got out of it right as it slowed down, so I don't know what you're talking about. But, a good credit market fixes a lot of bad companies.
Yeah.
And it literally just kicks the can down the road, and you're absolutely seeing that today. But whereas hot credit markets in the past, I think unfortunately, small businesses have been left behind.
Yeah.
You know, and whereas before, you know, they were able to find financing 8 years ago, they've just been forgotten about in this recovery. And unfortunately, you know, what's driving everything in the economy is small businesses. And,
You know, there's actually the haves and have-nots. What I see in the small businesses is there's now a line, and if you're over a certain level of EBITDA in a small business, you do have access to capital. But if you're below that line, whether it's 5 million or whatever, whether you're credit worthy or not, you do not have access to capital. There's a definitive line of have and have-nots in the small business sector.
Right.
You're right, Patrick. You need to look at the engine for the economy. You know, all 50% of all jobs comes from small businesses.
Yes.
And most of the job growth comes from small businesses. If we're not careful not to get off on a tangent, but I live this life every day and I've run for small businesses. If we don't fix that problem, that's just another problem down the road for job growth because we're not bringing capital to the people who create jobs.
Yep.
And it's a broken system and it's hard to fix, I agree. But it's a scary situation. It's interesting, especially to have not the capital perspective in small businesses.
Yes, I mean, there's a world up to 5 million EBITDA, as Patrick was saying, and there's another world from 5 to 10, and the third
Right.
world is 10 plus.
Right.
So it's very difficult to line folks up with finance and stuff.
You know, just one more illustration, most of your job growth in small businesses come from small businesses with 10 or less employees, and that's under 5
Right.
million EBITDA. And
Generally, yeah.
we are cutting off that potential, that part of our job growth. We're really cutting that back.
What do you guys
Any questions? Yeah, sorry.
From a company perspective, kind of the two EBITDA zones, sub $5 million if you're getting loans, or at 5 to 10 ballpark. What point are personal guarantees going away? Let's see if I'm getting close up.
Yeah, so I mean, we don't do a lot of kind of one-off debt financings. Everything's typically sponsor-led, so as you know, there's a sponsor in there, there's no PG. Although one deal we did last year, we had a pretty strong regional bank finance the company. We knew that we were going to eventually go through a sale process, and I think that bank wanted to have a part in the process, and they ended up providing all the financing for the sponsor sale. So they didn't look for a PG, but that was a business that was doing 8.5 EBITDA, and we put a $5 million facility in place. So I think the bank was pretty comfortable in that respect. But I still think anybody else that's kind of 5 million or below, or even maybe under 10, without a sponsor there, is probably going to be asked for some sort of guarantee. But again, we don't have a ton of data.
I would be surprised to see in a normal plain vanilla loan, a personal guarantee with a company with EBITDA over 3 million. Sort of, you know, and it is case by case specific, but as you get into story credits with companies with EBITDA less than 3 million, I think personal guarantee becomes part of the conversation for credit support. So, you know, some conversations we've had with, you know, companies that had a bad time and are now coming, you know, the loan's defaulted, it's been in default for 18 months, and a new lender finally steps up to the table, you know, almost guaranteed that there's going to be a personal guarantee if there's assets with the owners. But, you know, it is on a case-by-case basis, but generally don't see it with companies above 3 million.
Anybody else?
Thank you all very
Yeah,
much.
thank you very much.
Great discussion. Thank you so much, Ron and Pat and David. I want to thank you all for attending. I want to remind you all that our next monthly meeting will be Wednesday, June 19th, in the evening at the Royalton Roslyn Country Club. We're going to have our annual wine tasting event. We're going to have a speaker on entrepreneurship, David Feldman, who just wrote a book about entrepreneurship, will be joining us and spending the evening with us, 6 p.m. at the Roslyn Country Club. Look forward to seeing you all then. Again, our next CFO roundtables are June 11th and June 18th respectively. We hope to see a lot of you there then. You can always check out what our upcoming event schedule is on our website, li.financialexecutives.org. And thank you all for coming.